determine when and what types of information must be disclosed for geographic areas. Okay, so in addition to disclosing by segment, you also have to provide information about specific geographic areas. So for companies with international activities, they have to report two items: revenues from external customers and long-lived assets for the domestic company and all foreign company in total in which the enterprise, all foreign countries, I'm sorry, not companies, all foreign countries in total for which the enterprise derives revenues or holds assets. So what that does is it gives, assets in the United States are pretty stable, and, we're not real concerned about somebody coming in and taking over the company. At some points, some of the places in South America, in Africa, if you have some really crazy regimes in place, it may be very risky to hold assets in those areas, and so they need to report what kind of foreign assets a company has so that people can try and assess the risk. Okay, what do we have to report about that? Revenues from external customers and long-lived assets must be disclosed for the domestic company, all foreign countries where the enterprise derives its revenues or hold assets, and each foreign country which a material amount of revenues is derived or assets are held. If the company only has one operating segment and does not provide segment information, it still must report geographical area information. Okay, you might only have one operating segment, but you could have locations all over the world. Learning Objective 8-5. Okay, what else do we have to report separately? Well, we may have to report information about a major customer. Why would we have to do that? Think about it. If the majority of your business is associated with one customer, if that customer is potentially going to go bankrupt or have something go on in that company, it could be good news too. It could be that they're looking to take over a company and they're expecting assets to dramatically, revenues to dramatically improve. Users of the financial statements would want to know that. Okay. FASB ASC 280-10-50-42 requires one final but important disclosure. The reporting entity must indicate its reliance on any major external customer. Okay, what do they consider major? It's whenever 10% or more of a company's consolidated revenues, so total revenues of the company, excluding any inter-entity transactions. When you see the word consolidated, that assumes that all those inter-entity transactions have been removed. So we're going to, again, it's a 10% rule. If one customer is more than 10% of the total revenues, that customer information has to be reported. The existence of all major customers must be disclosed, along with the related amounts of revenue and the identity of the operating segments generating the revenues. So what they would have to do is list the customers and also under which operating segments those customers and that revenue is generated from. Now, it could be more than one operating segment. So you might have one customer and you might have 6 operating segments, and you provide the revenues are derived or earned from that customer in 3 out of those 6 segments. You would have to report that. International Accounting Financial Reporting Standards on operating segments. Okay, so what does IFRS say? Well, international standards and GAAP are very similar, except international standards require the disclosure of total assets and liabilities. If you remember, we only look at total assets if that information is provided to the chief decision makers. GAAP requires disclosure of assets, does not say anything about liabilities. International standards include intangible assets as long-lived assets. GAAP does not define what a long-lived asset is. Let's see, if a company with a matrix form of organization, international standards permit operating segments to be based on geographical area rather than opposed to product and services. GAAP does not permit geographical area. Okay, Learning Objective 8.6. Understand and apply procedures used in interim financial reports to treat an interim period as an integral part of an annual period. Okay, so what is an interim financial report? Well, that could be a quarterly report. It could be a monthly report if a company does that. Basically, we would not apply the same procedures for those as we would do for the annual one, but when we're all done, they should be flowing smoothly and become an integral part of the annual reporting period. So how do we go about doing that? The SEC requires that companies, publicly traded companies, provide quarterly financial statements. Now, these financial statements are unaudited. The companies don't have to go through an audit every quarter. They do have to audit the annual statements. There is a topic, FASB ASC Topic 270 on interim reporting, which provides guidance on how to prepare interim statements. There's two possible approaches to reporting them. Number one, it could be discrete. In other words, the accounting period stands on its own. They report the first quarter numbers. The first quarter numbers stand on their own. At the end of the year, they would take first quarter, second quarter, third quarter, fourth quarter, add them together, come up with total year. The other way of doing it is to look at the integral. We treat the accounting period as a portion of a longer period. And in that case, what's happening is when we record things, we make sure that the accrual accounting is done and that everything is looked at from the standpoint it's part of a total year rather than just it's part of a quarter. Okay, and FASB topic ASC 270 requires us to use the integral approach. Revenues. What do we do with revenues? Revenues are recognized in the interim periods in the same way revenues are recognized on an annual basis. So however you report revenues in the interim, you report it annually. Revenues from long-term contracts should be recognized using the same methodology as used on an annual basis. Okay, so when we talk about long-term contracts, there are a number of different methods that can be used to account for it. We have to use the same method for both the interim and the annual. A company should recognize projected losses on long-term contracts to their fullest extent in the interim period in which it becomes apparent that a loss will arise. So basically, as you're doing the long-term contracts and you're recording the revenue, you would do it just like you would at the end of a year. At the end of the year, you'd look at the contracts, see if there was going to be a loss, and you would report the entire loss. If you remember, conservatism says revenue, the income is reported as it is earned, the loss is reported as soon as it is recognized, or apparent that's going to happen. So that would be the same for a quarterly basis as what you would do on an annual basis. Other miscellaneous items related to interim reporting. Income taxes for each interim period should be computed based on the estimated annual effective tax rate. So in other words, the tax department would estimate approximately what percentage tax rate the company is going to be paying. Income taxes would be estimated on the income for the period based on that tax rate. Discontinued operations should be reported in net income on a net of tax basis for the interim period in which a business component is discontinued or classified as held for sale. So if it's reported as held for sale or it's been discontinued, we go ahead and report it as discontinued operation. Current guidelines require the retrospective application of new accounting principles to prior periods' financial statements. FASB ASC 250-10-45-5 requires that, number one, The cumulative effect of a change on prior period should be reflected in the carrying amounts of assets and liability as of the beginning of the first period presented. So if we make a change from, say, 2017, that affects 2017, that change should be reported as of January 1st, 2018. Any offsetting adjustment to record that change would be made to the balance of retained earning or other accounts that are appropriate, although typically it's going to be at least to the retained earnings account. And financial statements for each prior period are adjusted to reflect the period-specific effects. So any change from prior period means we have to go back and change those financial statements so that when the financial statements are presented side by side, we're comparing apples and apples, not apples and oranges. Learning Objective 8.7 lists the minimum disclosure requirements for interim financial reports. Okay, so at a minimum, what do companies are required to report? First thing they have to do is they have to report revenues, sales or gross revenues. They have to report income taxes and net income. They have to report earnings per share. They have to report seasonal revenues and expenses, so that's a little twist in there. And they have to report significant changes in estimates or provisions for income taxes. So, if there's been some change in tax rates, estimates for taxes are going to vary for some reason, those have to be reported. More things that have to be reported. They have to report the disposal of a component of a business and any unusual or infrequently occurring items. They have to report any contingent items. We talked about contingent expenses back in intermediate accounting. They have to also report changes in accounting principles or estimates, and also any significant changes in financial position. They are encouraged but not required to publish a balance sheet and cash flow. Many companies do because, many analysts kind of really expect to have that kind of detail. We report interim segments. We also have to report information, or interim reports. We also have to report interim information for operating segments. So what do we have to report for each reportable operating segments? First of all, revenues from external customers, inter-segment revenues, things that are going back between segments, segment profit or loss, and then total assets if there has been a material change from the last annual report. The enterprise must also report the segment's profit or loss to the company's total income before taxes. There's no interim disclosures about major customers or geographic areas. So there's only segment reporting on the operating segments and not anything about customers or geographics. All right, so what does International Accounting Standards say about this? IAS 34 requires minimum components in an interim report. They do require a balance sheet. They also require a condensed statement of comprehensive income, a condensed statement of changes in equity, a condensed statement of cash flow, and any separate selected explanatory notes. IAS 34 requires that the interim period be treated as a discrete period in determining the amounts. Expenses that are incurred in one quarter are recognized in full in that quarter, even though the expenditure benefits the entire year. Okay, so for an example, let's say property taxes, they're paid in the first quarter, but they really are for the whole year. You would report that full amount in the first quarter and then nothing in the other 3 quarters. There's no accrual for expenses in the earlier quarters for expenses that are to be incurred later in the year. The only exception to this rule is income tax expense. So property taxes wouldn't be included. It's just actually the income tax expense at each period. So very different. International standards require the discrete period. GAAP requires the use of the integral approach. And that is Chapter 8.